What is going on today in the stock market? We have Humana Inc. down 37% over the last 12 months, now trading at its 52-week low, and just now it is down 9%. So let's find out the reason in today's episode. We're also going to understand whether or not it is significantly undervalued. We're going to recap on how the company has performed, both on their top line revenue as well as their bottom line net income. We're going to understand why the reason for the drop. We're going to look at the health of the company, their total cash versus their total debt. We'll also see if this is an issue that is affecting the industry as a whole, comparing them to others in this industry. And we'll also touch upon some insider buying that we have noted a fair amount of 200,000 over the last week. We'll look at the institutions just to show you that not all companies and institutions are always buying more than they are selling. And we'll touch upon the dividend safety, which has a very strong score, and look at the supporting financial metrics. And as always, the main point is to understand what is the intrinsic value. Is it significantly undervalued based on our margin of safety and acceptable buy, and finding out what Wall Street's forecast is for the next 12 months. Now, before we do start, just to let you know, we have released our latest free weekly article. If you do want to gain access to this, as well as all others, all completely free, do click on that pinned comment below. So starting off, they are been hammered down 37% over the last year. Now, over the last 10 years, even after being down significantly over the 12-month period, they are up 193%. We can see all-time highs in 2022 of $554, quite some way away from where it sits now at its 52-week low. It does offer a yield 1% or just over, and we can see a market cap of over 40 billion. So firstly, before we deep dive, let's take a look and understand what is going on, why for this massive sell-off that we do see, not just today, but over the last few months. Well, we can see now, and it has been confirmed, that Medicare Advantage plans will receive an increased payment of 3.7% into 2025. Now, this is something that is set by the government, and they were hoping, not just Humana, but also others like United Health, as we will discuss later on, that this would be a much higher increase. But do also bear in mind, this was proposed in January, so it isn't something that was new, hence why that sell-off that has happened over the last few months. And one of the main things to understand here is that the CFO, Susan Diamond, did tell insurers and investors last month that if this was going to be the increase, then the earnings per share target that they had aimed for would not hit the upper limit, which is a disappointment to investors. And again, we will come on to the price targets over the next few sessions. So in terms of looking at their top line growth, one thing I do like about this company is their top line increases year on year. We can see it going from 65 billion in 2019 to 106 billion in their more recent year. So they've essentially done very strongly, nearly doubled in fact over the last 5 years. And every single year, very nice to note, they have been increasing their top line. We'll discuss the percentages over the last 10 years shortly too. In terms of the bottom line, not as strong as the top line, whilst we do see, in fact, increases over some years. Over the longer term, we see 2.7 billion go to 2.5 billion. So unfortunately, whilst their top line has increased very strongly, they have struggled to increase their bottom line net income. On a granular level as well, we see a very bumpy ride, an increase into 2020 before a decrease all the way to 2023. So something to consider, whilst they have been increasing their top line very, very strongly, their bottom line has been faltering, and we will come across that when we look at their metrics and apply that to our margin of safety. In terms of cash versus total debt, a quick health check. 4 billion of cash and equivalents in 2019, 4.7 billion in their latest quarterly report. So they have increased their cash position by around 15% over the last 5 years. Total debt, we can see, in fact, has doubled from 6.3 billion to 12.6. So their cash doesn't cover their total debt position, but we will analyze the net debt to EBITDA metric, which is very important to understand the dividend health safety. So looking at a few others in the managed healthcare industry, CNC, MOH, HQY, and a few well-known others that we have reviewed individually on the channel. Now, over the last year, no surprises, even after including those dividends reinvested, it is the worst performing in the industry, down negative 37%. When we extend that to the last 5 years, we do see it as one of the middle performing, up 23%. Not great at all, in my opinion, to have an investment up 23% over a 5-year period, but always important to understand that past performance is not an indicator of future performance. Now, interesting to note, very high institutional ownership sitting at 92%. We see a fair amount of sales, 9.3 billion over the last 12 months, although we do see a fair amount more, 14.4 over the same time period. But one thing I do want to point out, whilst we do see more buying in Q1 and Q2 of 2023, the last 2 quarters we do in fact see more selling by the institutions. So in conclusion, yes, institutions have bought more in 2023 of this stock, but do note that over the last 2 quarters, the red in fact higher than the green, they have in fact been selling more shares. Now we want to take a look at any insider movement, and we can see, whilst looking at both insider buys and sells over the last 2 months, Director Jorge M has bought, in fact, 20th of February, 545 shares, around 200,000 cost, and we can see since then the price is down 4.3%. But as we always say, insider buying is a bullish signal. Obviously, insiders would only buy if they believe the share price will go up. But always, these are different layers to our research. We look at a lot of different factors, but this, in my opinion, is a positive sign. But as we always say, do your own due diligence. Now, taking a look at essentially the dividend safety, we have a score of 99, very safe, the highest score obtainable. Market cap, it sits at 42.4 billion. It is a large cap company. Now, for those recessionary metrics, well, last recession, they paid no dividends, so no comparative data. Recession sales plus 6%, significantly above the average of the S&P, which was in fact negative 12%. But we do see they did trail the S&P negative 72%, with the S&P coming in at negative 55%. Now, in terms of dividend growth, we are waiting on an increase this year. However, over the last 5 years and the last 10 years, we do see strong double-digit increases, which is what we love to see from any company, including Humana, and they have been increasing those dividends for the last 12 years. So let's take a look at dividend yield theory. And now, for those that are new and first time on the channel, dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. So we have a signal of undervaluation here. In fact, probably one of the highest yields offered by this stock over the last 5 years. But bear in mind, we're not looking at any of these models in isolation, and we will conclude towards the end. Forward P, though, we do note it is slightly higher, 19.7 above the 5-year average of 18.7, and we can see it is slightly higher than healthcare sector P of 17.6. Now, in terms of the free cash flow payout, my personal preference, below 60%, it is a blanket rule that I have, just gives me faith that, like Humana, they can offer those double-digit increases we love to see. Over the longer term, in fact, hasn't once been over 60% or near that. 2023 at 15%, 2024 at 18%, we can see a very positive sign of a company when their free cash flow payout is very low and they are offering those double-digit increases to the dividend, so that is a positive for this company. One thing just to highlight as well for new viewers, we don't look at earnings data. In our opinion, it is susceptible to manipulation by management through accounting. Now, typically with companies, you want to see an increase in the free cash flow over the last 10 years. Very inconsistent. Yes, we do note more than 3 times growth from 2014 to 2023, but do note the inconsistencies with this company. It does make the valuation a little bit harder. And also, we want to point out free cash flow is expected to drop in 2024. Sales growth, well, I do like this. As always, steady moderate growth of 3 to 7%. They've done very strongly, in fact, even just over the more recent period, with some nice double-digit numbers to their top line. As we did mention, increasing their revenue hasn't really been an issue over the last few years. It has been about increasing their bottom line net income. And we know over the last 10 years, they have more than doubled their revenue, whilst also, which is very positive, returning excess cash to your investor pockets through those share buybacks, reducing them year on year, effectively giving you a larger portion of the company that you do own. ROIC, again, very strong double digits to that return on invested capital, one of my favorite metrics, as I always want to see 10% or more, just to give me faith that management are able to effectively allocate their capital, and they have done that every single year. Last 2 years at 16%, nice and attractive for those potential investors. Now, this is probably where we can see the struggle does come from, with their operating margin fairly low, meaning that their bottom line does struggle to increase. Ideally, we want to see above 12%, but we do want to point out that this is very similar to other companies like UNH as well as CVS. Free cash flow margin as well, they do struggle with that 5% level, as we can see here as well. So not everything is great with this company. There are some areas that we would like them to improve, but we do also note with their margins, it is something that has happened consistently over the last 10 years. On a more positive note, their net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization, is 0 every single year. Now, this correlates to both dividend safety as well as balance sheet strength, and shows us the number of years it would take the company to pay off all of their debt net of cash on hand. It wouldn't even take them 1 year, so very, very strong. In fact, wouldn't take them 1 day. So very strong balance sheet. Dividend does not look to be questioned, so let's get into the valuation. As always, if you do enjoy the content and value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model we use is the multiples valuation model. We have companies in a similar sector and size. To get their PE, we get the average of their PE, multiply it by the EPS of Humana, and we get an intrinsic value of around $399, as we can signal here an undervaluation sign. Do remember though, we don't look at any of these models as well in isolation. We then look at their dividend growth through the dividend discount model. We can see average growth of just over 12%, very strong. Forward looking, we've tried to be a little bit more conservative at that 7% mark. And we can see another sign of undervaluation, so a double sign here. Thirdly, we do look at the DCF model, the discounted cash flow model. Now, we can see in the more recent year, it did drop 8%, still very strong at over 3 billion. And we can see we've gone for what we believe to be a very conservative metric or mark at 1%, given the average growth at 78%. With the discount rate, we get the present value of future free growth and terminal value. When we add together, as we can see, with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, we get to another undervaluation signal. So essentially, the intrinsic value today for Humana is just the average of these three models, and it's arriving at $384. Now, in terms of looking how that compares to the current price, well, we see the current price around 316, and we do use our margin of safety, and we always start off with 10%. Although if you do buy companies at trade at a premium, you may have a different number. Now, we use 10% if we believe it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Then we keep going essentially till it's near that current trading price. 15% still a buy, 20% not quite there yet. So for today's episode, based on the updated metrics and numbers for Humana, we see a 15 to 20% margin of safety level. But do, as always, let us know your thoughts, whether or not you believe that is sufficient, whether or not you're buying, and maybe you have it on the watch list at a certain price. Wall Street, they still believe, even after revising their price targets down after this news, that it will hit around $407 over the next 12 months. They see upside of 29%. Again, they indicate this as a very strong buy now. As always, though, do let me know your thoughts. For me personally, this is a very strong company. We did see the news. You could ask yourself whether or not the market is overreacting, given how strong the metrics are. The undervaluations shown in our models, especially when you look at the discount and cash flow model, the average growth over the last 10 years is 78%. We've gone incredibly conservative at 1%. For example, if we had increased this to say 4%, you can see the intrinsic value does go up significantly more. However, we do want to be conservative. So you can see, in my opinion, this is a very strong time to buy if you do believe in the fundamentals, if you believe in the company. For me personally, this is definitely one on the watch list. However, I do hold UNH, I do hold Allegiance Health, which I do prefer, and I have in fact been buying them as well, which I will release on another episode today. As always though, do let us know your thoughts. If you enjoyed the episode, smash that like button. Do not forget, you can grab a copy of the valuation model to get to both intrinsic value and acceptable buy price of companies in your own portfolio and on your watch list by clicking on that pinned comment below. As always, have a great day. Let me know your thoughts, and we'll see you all on the next one.